So I think we have the sentiment there now, the backdrop and sentiment there now, where we can come out of this. And I believe normally I'd say a parabolic usually comes at the end of a move, at the end of a big cycle move. But in this case, it was so fast and it unwound so fast that I think there's even a steeper move following that. So if you can do that in 3 months, you can see another. My target on gold is 7,000. My target on silver now is 200. So particularly silver, being where it is down just under 60, if it can go from 60 to 200 this year, and maybe even faster than the end of the year, that's pretty steep. And gold, obviously, if it can go from 4,000 to 7,000, would be an unbelievable move. So that's what I'm seeing, and that's what I expect.
Gold and silver have taken a massive hit from their January highs, with gold testing support near $4,000 and silver trading just under $60 after a staggering 33% pullback. Leveraged positions have been violently flushed out over a painful 5.5-month correction, leaving mainstream investors highly bearish. But this sudden drop is building the ultimate pressure cooker dynamic as the market quietly prepares for the next explosive move. Macro strategist David Hunter sees this violent unwind not as a permanent breakdown, but as the perfect sentiment fuel for a massive vertical leg up, while mainstream Wall Street targets a modest recovery. Hunter expects gold to rocket from $4,000 to $7,000 and silver to more than triple from $60 to $200 before the end of the year. He warns that a deflationary global bust is lurking, but a jaw-dropping parabolic squeeze will hit the precious metals markets first. Is the bottom officially in, and are you prepared for what Hunter calls the ultimate cyclical explosion? Stick around until the end to see the exact timeline for this massive surge. But before that, if you find this analysis helpful, please hit the like button, subscribe, and turn on notifications so you never miss our deep dives into the markets. Thank you for watching, and let's get into the video.
So gold, I'm equally bullish on gold and silver. We had that great run from November to January in silver, and gold was a longer run than that. But silver got up to 122 from it had been in the 50 area when it broke out. That was a long-term breakout point. There's 48 or 50, and it just took off and basically went parabolic. Covered more than doubling in probably 150% in 3 months. And so you had to correct what was speculative blow off. People were just through the roof in bullishness, and you had to correct that. I thought it'd correct in a few months, but it's taken 5.5 months now, and you've gotten a lot of that speculation out of there. Certainly a lot of people who jumped in the last inning of that run. They weren't there at 50, they weren't there at 75, they might have gotten there over 100, and all of a sudden they're down in half almost. And so that wakes you up in a hurry and turns you bearish in a hurry. So I think we have the sentiment there now, the backdrop and sentiment there now, where we can come out of this. And I believe normally I'd say a parabolic usually comes at the end of a move, at the end of a big cycle move. But in this case, it was so fast and it unwound so fast that I think there's even a steeper move following that. So if you can do that in 3 months, you can see another. My target on gold is 7,000. My target on silver now is 200. So particularly silver, being where it is down just under 60, if it can go from 60 to 200 this year, and maybe even faster than the end of the year, that's pretty steep. And gold, obviously, if it can go from 4,000 to 7,000, would be an unbelievable move. So that's what I'm seeing, and that's what I expect. I realize there's lots of people out there in that field, people that follow gold and silver closely, who think they both have more to go. There's the breakout in silver was 50. Gold looks like it could go back 3,500. And so I can't say that's impossible, certainly, until this thing really gets turned around and you start seeing a little more upside. There's always a risk that, this is just another dead cat bounce and it goes lower. I think based on what I see in sentiment and what I see in the in the charts and everything, there's a pretty good chance we came down to a trend line on silver, and gold looks like 4,000 or 3,900 is a pretty good place. And ironically, and I didn't do it for this reason, but if my numbers, and my numbers may not be right, but if my numbers are right, 200 on silver to get back down to 50 would be about 75%, and it would be exactly 75%. That would be, kind of a normal in the, if I'm right about what equity is going to do and what we're heading for in terms of global bust. Silver is a very cyclical metal, and it will get hit almost as hard as equities. 75% would make sense to me. That would take you back to that 50 breakout point that all these technicians think is necessary to get going. So you could have it, but not have it now and have it later. Got down to 56 in this correction. Gold from 7,000 to 3,500 is 50%. 50% retracement would be a very normal retracement in anything, but in gold, certainly that would make sense. So whether those numbers are right or not, I didn't get to my numbers that way, but the other day I just said, oh, those are convenient, kind of places where it could correct from. So I think the possibility is that all those people waiting here for that last shoe to drop, as often the market doesn't accommodate, you take off from here and you get to those breakouts, those natural places where it should go down to in the bust rather than now.
Well, your target of 7,000 an ounce for gold is actually bearish compared to some of the analysts I've spoken with who are calling for over 10,000 an ounce with a plan for the Fed, for the government to actually revalue the gold on the balance sheet in order to maybe address the debt or to participate in some kind of monetary reordering like a Bretton Woods 2, which Treasury Secretary Scott Bessent has actually alluded to in some of his writing and speeches from years past. Like, do you think that might be a plan going forward to revalue the gold?
I know there's been talk of things like that, and certainly a lot of speculation in markets about that. I guess my feeling is that we're too close to the bust for anything like that, because that's going to take time. You just don't all of a sudden roll out, we're revaluing gold, and I'm not sure how we do that exactly anyway. It's not like we're in charge of that. So I'm skeptical of that, certainly skeptical of it happening before a bust. By the way, I do have a $20,000 target for gold. It's just that I think that comes in the next cycle when we have all that money going to work. It drives the next cycle is going to be a commodity cycle, an inflation cycle, and I think gold and silver are going to be the top performers in that, or among the top performers. So I have silver going to 1,000 and gold going to 20,000, just not this cycle.
Okay.
So I'll top them, but just not now.
A massive shift is happening behind closed doors at the Federal Reserve, and it changes everything for your money. With Kevin Warsh nominated as the new Fed chair, macro strategist David Hunter believes we are entering a brand new era of central banking. As a self-described monetarist, Hunter strongly endorses Warsh, calling him made for the job due to his deep, long-term understanding that reckless money printing inevitably fuels inflation. Crucially, Hunter rejects the idea that Warsh will clash with Donald Trump's desire for easier monetary policy, pointing out that markets, not the Fed, ultimately dictate long-term interest rates. But Warsh's biggest paradigm shift? Ending the era of central bankers acting like media rock stars and pulling the Fed back into the quiet background. Can a tight-lipped, inflation-fighting Fed actually stabilize a volatile market, or will this lack of forward guidance catch investors completely off guard? Stick around as we break down exactly how this new Fed strategy will impact your portfolio.
What do you think of Kevin Warsh? Is he the right man for the job as the new Fed chair?
I think he's great. I think he's almost made for that job. I'm basically a monetarist myself. I do think he understands that over time, not short term, but over time, money printing leads to inflation. And if you allow inflation in your country, then you're gonna have all kinds of problems. So I think he has the right mindset. He's a long-term thinker. He's not trying to call rates between each meeting. I like his idea that we should be doing less talking as a Fed. It got out of hand, not just under Powell, under Bernanke, under Yellen, and before that, maybe some under Bernanke, where it was like they're almost rock stars. They wanted to see themselves out there making their pronouncements about what they think the next rate move is. And I mean, years ago when I was following the Fed, we just didn't see that. Certainly under Greenspan, we didn't see that. And even before that, the Fed was in the background. They weren't up front and center and on TV all the time.
Well, and we saw Trump get so sick of the last Fed chair. He nominated Warsh, but Trump really wants easier monetary policy. So do you think there's going to be some friction there?
I don't think so, and it'd be interesting to know what the conversations were before he got nominated. But Kevin Warsh is an inflation fighter, and he's somebody that really understands you lower rates prematurely, and you're going to have higher rates, not lower rates. If you ease too soon, you're going to have inflation problems, and rates will follow. So he understands more than anybody else. I think that, and I've always said this: markets determine rates, not the Fed. So yeah, the Fed can control the overnight money rate, but it doesn't control where rates go longer term. And so it's kind of, again, Trump's a real estate guy and he always wants lower rates, but the Fed's not in control of that. And we saw that obviously a couple of years ago when they cut rates in August, I think, or July or August prior to the election. And, long rates went the other way. So I think Kevin Warsh is his own man. I think people somewhat misunderstand. Trump was more upset, I think, with some other things that went on with Powell that made him feel like he's just another TDS guy, whether he's right or wrong. I defended Powell a lot through those years, even though I do think Trump has been under the gun from a lot of people. I did defend Powell in saying, basically, if you look at the Fed, how can you fault them? They've brought rates down and kept the economy going, or they brought inflation down and kept the economy going through most of his time. The Fed was more right in what they were doing. They were getting criticized for not fighting inflation enough or not easing enough, and yet in the end they had it kind of just right.
Whether you are bracing for the initial explosion or eyeing the long game, one thing is certain: the financial landscape is undergoing a massive transformation. While the immediate vertical surge in gold and silver catches mainstream Wall Street off guard, the real story lies in what happens after the smoke clears from the impending global bust. David Hunter makes it clear that the upcoming economic reset will pave the way for a historic, multi-decade commodity supercycle. In that subsequent inflationary era, he predicts gold will ultimately skyrocket to a staggering $20,000 an ounce, with silver surging all the way to $1,000. The rules of investing are being rewritten in real time under a new Federal Reserve, and traditional portfolios may find themselves holding dead money. The window to position yourself ahead of this historic macro shift is closing fast. What is your move before the financial system resets? Let us know your thoughts in the comments below. If you found this breakdown helpful and want to stay ahead of these historic market moves, make sure to like, subscribe, and turn on notifications so you never miss an update. Your support helps the channel grow and keeps you informed when the markets shift next.